Hunter, it's good to be back. Closing out our series on our 2026 outlook, really providing our listeners with what we're looking to most here in 2026 as far as markets, investments, and all the things we cover here at Beckonomics. I'm excited to get into it today.
Yeah, me too. Excited to dive a little bit deeper today. In previous episodes, we talked about AI supercycle, kind of the infrastructure, your downwind of that, all the things that are required to build that up, along with the Fed and more macro drivers. So we're talking really high level about all these things. Today, we're diving a little bit deeper into specific sectors that we're really interested in. So excited to, get a little more into the nitty gritty.
Exactly. I mean, we really started off that first segment diving into our biggest megatrend still being that AI space, but now it's going to be exciting to talk about some of the more specific sectors, things that aren't just in the headlines every single day that have been, so under focus. So, because of course we're building diversified portfolios here. We're not just going to be 100% levered to the AI trade. That would be negligent on our part. And there's a lot else to be excited about. So it's going to be kind of fun to talk through some of that stuff and just go through kind of a sector by sector. And then of course, attack some of the risks that we're looking at this year.
Yeah, exactly. And kind of to get it out of the way, because we're trying to move a little bit beyond what the headlines have shown and what we've kind of already addressed. But, starting off, we should address those downstream from AI sectors that are going to benefit from this huge CapEx build out. Because again, you have hundreds of billions of dollars chasing additional data center capacity. You're going to need power to power it. You're going to need a lot of industrials from, simple things as earth moving equipment to prepare the land, all the way to the racks, the HVAC, all of the things that go into actually building that data center. Not to mention the actual chips, the memory, the hardware, your, copper cables, your glass, fiber optic cables, all sorts of things that go into these things.
Yeah, I mean, we kind of covered this a lot in our first segment, but at least so far year to date, what we've really seen is the people who are receiving the checks from those AI hyperscalers, from the huge mega cap companies, those have been the companies really benefiting so far in the cycle. Mm-hmm. It's really been the software that's been left behind, including some of those mega cap names, outside of, say, NVIDIA, who is a big recipient of the AI CapEx spend. You've seen huge CapEx budgets from Amazon, from Google, from Meta. And it may be, and we'll talk about this later when we get to some of the risks, but it may be a year where, hey, the mega cap names, because all of them are spending so much money in the AI space, do see kind of a pullback or just kind of a flat tape, maybe not the outperformance that we've seen in recent years.
Yeah, I think that's going to be an interesting thing to look at because they've really benefited early on from this investment phase due to excitement about what will ultimately get there. And we're kind of running into, where market participants are realizing, okay, this is a multi-year build out. It's not we invest today, we profit tomorrow. It might take a little bit of building and investing. So that's I think an interesting point in kind of where the market's shifting is okay, well, maybe I don't want to own these names right now when all of the profit motivation here is coming a year, 2, 3 from now.
Exactly. Now, as we get into some additional sectors, financials are one that I want to talk about first. Of course, it is a broad sector. A lot of companies and industries fall into the financial sector, but specifically, you and I are looking at banks and M&A and asset managers as far as who we're really interested in investing in and who we think have the tailwinds going into this year. Most notably first, it's looking like, especially after the nomination of, the next Fed chairman, Warsh, or likely to be next Fed chairman once he's confirmed by the Senate, we've seen kind of a normalization of an upward sloping yield curve, which traditionally helps banks because they are taking in assets under very short term yield basis where they're paying on deposits, but they're lending it out at longer term. So a more slope to your yield curve, being those longer maturities, 10 plus years, having higher yields than your short end maturities of your overnight rates or your very short term kind of CD. Think of CDs, or a lot of our listeners might be familiar with bank CDs. That's short term paper. If you're paying less on the short term, you're receiving more on the long term. That usually benefits banks in that regard.
Yeah, and they've been in a tough spot for a while leading up to this because we had an inverted yield curve for a while where the long end is actually below the short end, and that makes bank's job much more difficult because it's hard to lend out mortgages, say, or even just company financing at 10, 15-year terms if you're having to pay more than that for deposits. So kind of a return to normal in that area is going to be beneficial for them. And because of that, I think a lot of these banks have shifted and focused more on alternative business lines, such as asset management, such as their M&A branches and their investment banks, because there's not so much money being made in the traditional banking side, and they just parked all of their cash at the treasury. Now, reverting to normal a little bit, but still maintaining what you've built over those past years in your asset management arms.
Yep, exactly. And I think our preference here too is going to be more on that commercial lending side rather than the retail side, just because we do have some concerns, and we'll talk about this in the risk segment, about the consumer, about consumer debt levels. While it's not terribly unhealthy right now, our preference is just for corporate debt. And so sticking with the banks that do issue more corporate paper than consumer, I think is prudent right now. Now, I think the segment of banking and financials that I'm most excited about is investment banking. You're seeing huge demand for M&A right now, so mergers and acquisitions, companies taking each other over, as well as new initial public offerings, IPOs. The regulatory environment's really favorable for this right now. We've got a pretty, lenient FTC and DOJ, and so they're letting these deals go through without too much pushback for the most part. So you are seeing a lot of deal activity, and these investment banks are getting paid a lot to consult or provide the issuance of that stock, or in a lot of cases also bonds, to the market. I mean, we were just talking about AI CapEx. A lot of that's having to be funded with debt. That means new bond issuances, investment banks getting paid for that as well. So you have a lot of dynamics that are very positive for your investment banks.
Yeah, and there's been a lot of pent-up demand for M&A activity under the previous administration, coming out of COVID and all of these things that have just prevented companies from going and doing these acquisitions, IPOing, whatever they want to do. And so they've been kind of waiting, and then, Fed was hiking rates, and now they're finally coming back down into what's a great environment, like you said, for this M&A activity. And we were expecting a lot of that last year, and it took a while to see that come through. I think that was a little bit slower of a ramp back up before, companies felt, secure in, let's go make this big acquisition, because these are big events for companies generally. Even very large companies are oftentimes, spending very large amounts of money to buy people. So it's not, a kind of willy-nilly thing. So I think they've just been waiting for a little more reassurance from the markets, from the government and Fed before they feel really comfortable in doing this. And it's nice to see that activity finally really picking up. And I think there's a lot of that pent-up demand still there that we're going to see come through.
Yeah, no, I completely agree. And I think a lot of this we have to acknowledge has come because rates are now lower. Mm-hmm. It makes that cost of capital lower for whether it's an acquisition, whether it's for debt issuance, whether it's an IPO. And even though you're talking about equity issuance, just overall cost of capital is more attractive in public markets. So lower interest rates just make a more open, easier environment for all of this activity that does benefit those investment banks. And I'd say like kind of the third, pillar of this financials tilt or bullishness towards the segment would be your asset managers. Of course, the market has done fairly well the last few years. So banks that have large investment management arms are poised to benefit, of course, because of this great generation of wealth that we've seen over the past few years and the recurring revenue that's generated via investment fees in that space.
Yeah, and to that point exactly is we've had a great few years in markets, and as asset managers bill on AUM generally, those fees increase along with the market, so you get kind of a compounding effect there. And something interesting that I don't want to spend too much time on or read too much into, but that we'll kind of explore in a later section when we talk about software is, a recent piece of news and a recent, 1 day kind of scare with asset managers where, it was a pretty minor thing, but there's a brief period where people thought, oh, AI is coming for asset management next year or something all of a sudden. That turned out to be, not exactly the case. And so things have resumed their normal trajectory since then. But I think that amount of kind of fear in the markets around what AI can displace was seen very evidently in those asset managers. And I think, that's a good old case study on the broader software industry and what's going on there.
Yeah, I agree. And we'll talk to those points whenever we get to the risk segment, but I definitely want to table that because it is interesting seeing how AI is playing into market philosophy right now and psychology as far as how it's impacting a variety of industries and segments. Now, I do want to get to our next sector that we're really looking at, and it's one that we've been bullish on for some time, at least the last couple of years, and that's aerospace and defense. And of course, a lot of that is driven by the obvious. There's more geopolitical tension around the world. The U.S. is getting involved in more disagreements or conflicts. Granted, you have what feels like just as many wars starting as are being concluded, but you've got the war between Russia and Ukraine that continues to carry on, which seems endlessly at this point. You've got disagreements and conflicts in the Middle East. So investing in those aerospace and defense companies, seems like a prudent approach to what's more stable sector outside of your volatile, AI and technology investments.
Yeah, exactly. And whenever we're having to replenish our stockpiles of munitions that have been sold, given to foreign countries who are involved in these conflicts, as well as build out for what looks like the future of warfare and all of that, combined with the European Union being a huge driver of this and doing, kind of building out their capabilities not for the first time, but really doubling back down and identifying this as an area that, hey, we need to actually invest here instead of just kind of poke along like they have been. And so between all of those, really the three main things, U.S. rearmament, U.S. advancement, and European catch up to where the U.S. is at, I think all of those are big drivers and will continue to be big drivers, even if we see the Russia-Ukraine war concluded. I think that might cause temporary price disruption for some aerospace and defense companies, but I think even if hopefully that were to happen, you would still continue to see plenty of demand.
Right. And I think tangentially, I would include cybersecurity in that as well. More and more, wars, if you will, are being fought on the digital front. Mm-hmm. And so that's an area that we've been invested in for quite some time and is a little bit different from your traditional SaaS or, software as a service, enterprise software space. I think it's more insulated than a lot of those other companies. We'll kind of speak to that in a moment, but is another piece that I'd include in that aerospace and defense sector. Next being industrials and robotics. Of course, we've talked a lot about the industrials that are linked to AI infrastructure. I don't want to belabor that point anymore, but robotics, I think, are something that's very interesting as far as the interplay with industrials, with this resumption of manufacturing within the United States. And I think there's a place for that in portfolios now as well.
Yeah, I agree. And if you, kind of taking a step back to Econ 101, you have, productivity from, labor and capital. It's a combination of labor and capital. And we have expensive labor in the U.S., but we have capital. We have the biggest financial system in the world. We have highly advanced technology and a lot of really intelligent people developing new technology. And so we need to lean into that capability to be competitive on a manufacturing front. And we've seen this already take shape to an extent, but continued investment in the area of automation and robotics in order to get that done, because we don't have the people for it. Our population's not big enough in the grand scheme of the world. The U.S. is actually not that big, but we have the capital and the technological know-how to lean into that robotic side and actually be competitive on a world stage via autonomy.
Exactly. I couldn't have said that part better myself. I think another interesting area of industrials is in the transport space. And while we're not heavily invested in this area now, it has been a very good performer year to date. And it's been interesting to follow because transports have been so volatile since last April when we had the tariff announcements. Everyone was worried that, freight was going to be weighed down because we weren't going to be conducting as much trade as we used to. Well, it looks like, through a combination of lower interest rates, increased AI infrastructure production, kind of a slight resurgence in real estate, build out, you are seeing increased demand for freight within the United States, for transports, for the industrials that benefit off the back of that. So I think that's also another interesting space that is getting more and more attention, and it looks like the demand is going to be there for some time in the transport space as well.
Yeah, absolutely. And there's a lot of varying factors in the transport space that I think are interesting. You have the actual trucking, you have the warehousing was built out really heavily, has seen a period of reconciling that oversupply and is now kind of moving forward once again. And being in that kind of intermediate space where AI can't directly take that over, but at the same time we're seeing some cool stuff come out of startups about autonomous trucking. I think it's just a really interesting space to watch. I'm with you that a lot of it is, it's hard to tell where exactly it's going to go, but I think it's going to be very important for the economy. So definitely something to keep an eye on.
Yeah, absolutely. Now, the final sector that I really want to highlight, and one that continues to excite me, even though traditionally it's not the, sexiest sector necessarily, is healthcare, and then biotech as well. With an aging population and just older demographics here in the United States, obviously there's huge demand for increased healthcare services, for pharmaceuticals. As you have higher and higher rates of, chronic diseases, things, like heart disease and cancer, you have new, biomedical and biopharma resources and products that are trying to address that market. So I think being invested in a combination of those is prudent. Of course, I think the other thing that is exciting about the healthcare sector is it's not just a buy it and forget it kind of. You can't just buy the whole basket, if you will, because, and this is why we like to be active allocators and, stock selectors, is because managed care has not been the place to be in the last, at least the last year or so. And that is probably, I'd have to look up exactly what it makes up of the healthcare sector, but is a huge portion of the healthcare sector. And if you were just allocated blanketly, to the sector as a whole through an ETF or something like that, you're going to have exposure that is not necessarily something that you want to hold. Given the regulatory environment, how the government is interplaying, it's a space where you really have to pick and choose what you're going after, which is what makes it exciting for people like you and me.
Yeah, absolutely. Because you have part of the category, part of the sector that is so susceptible to government programs around cost efficiencies and just cost reduction for individuals. And then you have part of it too that has been largely insulated from that because, when you're creating new drugs and cures for people, you don't want to inhibit that. And a lot of that, at least domestically, has been, preserved through the most favored nation agreement and stuff like that. And so they're not really getting hit in the same way that other aspects are. And so that's been a really interesting thing to watch. And to your point, makes an interesting sector to be invested in, along with all the advancements we've seen, from specifically, biggest one recently, the GLP-1 space, now oral versions coming out, a lot of legal drama with Hims and Hers Health copying that, but then it looks like that's still back in Lilly and Novo Nordisk's basket there for the time being, at least. But that, along with a broader political push to make those like biosimilars and generics more available through, again, affordability programs, especially for old medicines that are around but still somehow under patent because they keep tweaking it just enough.
Right.
Getting those out to market and allowing prices to come down in some areas while still supporting the M&A of those biotechs creating new cures for diseases.
Yeah, exactly. And I think you mentioned the GLP-1s. I think that's kind of where you want to be allocated to in pharma because that space, I think, is under some threat from the macro, from the geopolitical type risks that you were mentioning. I think biotech is an area that was really frowned upon when we were under a higher interest rate environment. Biotech has just historically done poorly under environments like that because it's all about cost of capital for that business. How much research can you fund and how much does it cost to fund it? Well, now that interest rates have come down, it's a lot cheaper. And so that area is more attractive. You also have the implementation of AI in the biotech space now, which ideally, in a perfect world, is going to help drug makers find these new cures, these new drugs faster and faster. Providing more care for more individuals, but also driving more profitability for the underlying companies. So I think that space is really interesting. Like I said, I'd stay out of managed care. I'd stay out of most of pharma. But, I think medical devices are interesting because of the aging demographics, the GLP-1s, and, biotech as kind of a broader segment is really interesting in that space.
Yeah, absolutely. It's really cool to see what some of these companies are doing as far as, AI in the space, how they can model the drug interaction that was before pretty, best guess and let's experiment kind of thing. That combined with, like you said, a lower cost of capital because this is all R&D until you hit something that works. So it's an exciting space.
Exactly. Now let's talk about everyone's favorite, the risks facing the market this year. I think it's prudent for us to acknowledge what the risks are, to be thinking thoughtfully about them because, as we're constructing portfolios, we want to be aware of what are the greatest risks facing the market. And these are kind of some of the top ones that you and I have identified. I think first and foremost, and this is a hard one to play around, but certainly something that's going to impact the macro are current tariffs and the IEEPA decision that is coming down the pipe really any day at this point. It's going to be interesting to see when that's announced. It's been kind of pushed off by the Supreme Court for some period at this point. But the point being is that tariffs have been largely accepted at this point. And you've had them in place for such a long period that most of the price increases have kind of trickled through. Of course, that was on a delay, but I think most of the ramp in prices from those initial tariffs have found their way, whether it's the importer that's paying part of them, the company is taking some kind of margin hit, or probably what's half or more is being passed along to the end consumer. That has essentially happened at this point. So now the market's kind of looking more favorably upon tariffs, at least Wall Street is, as far as a tax revenue driver, because it is limiting the federal deficit. And so pushing back against the federal deficit and federal debt is very attractive to bondholders, for treasury holders. So it's impacting the credit space. And we all know that the credit space leads the equity space. And so I think it's going to be interesting to see what kind of decision comes out and how, depending on how they decide, which it looks like they may decide that IEEPA was used improperly to implement tariffs, that could have some implications for especially credit first and then the equity market.
Yeah, because great summary for one, because that's a lot of moving parts here. But looking at Jerome Powell and the broader Fed, they've stated on a number of occasions that they expect that very thing, that most of the price increases have come through and will, around between April and mid-year of this year, fall off of that inflation number. So they're expecting lower inflation going forward, because that's a one-time step up in price. It's a price change, but it's not a continuing price change, which is what inflation tracks, really. And so that will fall off inflation. And so the idea being that the prices have increased, that's done. And we're just kind of moving forward from that base location. And then, like you said, having that additional revenue for the U.S. government has been, really good, because there have been debt worries this year. And, adding, that, or really removing that revenue, is just another kind of concern for bondholders. And so, you always have the plus side of that being that companies would get margin relief. They would be a little more profitable, which on one hand helps the stock market, helps those companies. And then on the other hand, you have the very real possibility of, like you said, the bondholders get concerned because our deficit is worse, looks worse, fewer outlets to fix that. And then, those balance out to a certain degree. All in all, I think it'd be a, modest negative to the markets, because, for reference, IEEPA covers about half of our tariff revenue currently. So there are other avenues, and the admin has talked about having alternatives other than IEEPA to implement these tariffs. But I don't know how much appetite there is to, have those taken off, add whole new tariffs, and just shake up the whole system again, when it looks like the presidency is leaning more towards that affordability push, especially leading into midterms.
Yeah, I think that's a perfect segue into risk number 2, and that is the K-shaped economy that we're kind of witnessing right now. And so when we say K-shaped economy, we mean, you have this divergence where, the wealthy are getting wealthier, and, your less fortunate Americans or low-end consumer is getting pinched harder and harder. And a part of that is because tariffs have led to some increased prices. And the thing is, even if tariffs get rolled back, it's going to be unlikely that we're going to see prices drop, commensurately, just because historically companies have not been very quick to roll back prices, even when they have the opportunity to do so. They're going to be looking more to maintain margin or expand their margin. And then it's also unlikely that or at least somewhat unlikely, that the administration looks to re-implement those tariffs quickly, because there is this big push and concern with affordability. So I will say that is the benefit driving, that piece as far as the K-shaped economy and affordability, is the administration is looking to make America more affordable, to decrease inflation, and kind of drive better outcomes for that lower half of that K. But what we've seen are, rising debt burdens for that lower income group. It's not dire yet. It's not looking, really stretched, but it has become, more unhealthy than it has in the past couple of years. And so it's something I think we should really watch, because at the end of the day, the economy is going to drive markets. And if you have too big a contingent within the economy, not being able to sustain a healthy living or high quality of life, then you kind of create some problems for markets along the way.
Yeah, and it's on the bright side, I don't think that's anything foundational. It's nothing that structural to our current economy. It's still we're all so much better off today than we would have been 100 years ago.
Absolutely.
But, I think a lot of that was spurred by inflation and by a good stock market. And so those who own assets have been insulated because assets not only have gone up, but also go up in price. They inflate along with broader inflation. So they protect you from inflation typically. And those who don't make much money and living paycheck to paycheck don't have assets. They're spending their money as they receive it generally. And it's hard for them to, build that base. And so they end up getting a little bit left behind there. And so I think a little bit of, we're not in a hole we can't dig ourselves out of. It's not anything structural to the U.S. It's just a factor of, this recent inflation. And I think, maybe it's through the affordability pushes, but it's not insurmountable, I'd say.
No, I completely agree. And I think that's why it's just something to watch. And, ideally that'll continue to get healthy. I think the combination of wage growth being healthy recently, we've seen wage growth continue to outpace inflation, especially that inflection is getting more and more positive as inflation continues to come down. Wage growth has stayed pretty healthy, and we aren't seeing AI displace too many jobs at this point. So that being the caveat, which I think we can go ahead and have it lead into our next risk. And this is what markets have spent a lot of time focusing on so far this year is, Hunter, begs the question, is AI eating the world?
Well, a lot of people think it's going to. It is not currently, but can confirm that. But I've heard all sorts of estimates. Microsoft's own head of AI thinks, a year, 2 years from now, you're displacing massive number of jobs. Most people are on the longer term side of that and really not worried about that, generally, because we've had a lot of different revolutions, industrial and technological in nature, and that have put a lot of people out of business, but also driven new things for them to do, new professions. So the economy generally finds a way in that instance. But if you ask the markets, AI is eating software, and I want you to unpack that a little bit more. But the software broadly, especially software as a service companies, have really gotten hit this year.
Right. And I think this is really interesting and also provides a really good investment opportunity. But what the market has done so far this year with AI implications for businesses is it's really hit sold first and then ask questions later. We saw a lot of blanket selling of software companies, throughout the last month or so. And this has all been leading up to this moment where it's been exacerbated, but it's really been happening for the last year or so, because the concern is that if AI is able to write all types of software, then these institutionalized software companies, they may not exist because a startup could just go ahead and write all the code and replace the product offering. Well, that may be true for some enterprise companies that have a lower end offering, something that's less sophisticated, that doesn't require the back end team, the back end support, and the integrations with a client's broader tech ecosystem. That may be true. If it's a very simple piece of software, that may be replaceable. But we're not really seeing that yet as far as broad software stacks. I think it is creating some opportunity in the software space. So I think what we look at as investors is many risks also provide opportunities. And the software space is just one of those. And especially right now, you and I are spending a lot of time focusing on, hey, which companies are the ones that have, deep roots in their current client base, who is truly integral and not easily replaceable.
Yeah, exactly. I think a lot of it goes back to, why moats matter. I think it's, to take an adage that I heard a lot, maybe a decade ago, was the baby getting thrown out with the bathwater, is you're just hitting sell on the whole sector. And there are a good chunk of those names that have moats, that have defensible IP that can't just immediately get replaced. I mean, even Jensen Huang himself, NVIDIA's CEO, was talking about this and saying that these tools already exist. Why would we replace those tools with AI? AI should be using those tools. And so in a lot of instances, that makes sense. In others, if the tool is maybe reducing complexity, say, not to pick on anyone here, but like tax software, for example, taxes are complex, but they're not, the tax code is very spelled out. That can be, maybe more eligible to be replaced throughout because AI is really good at reducing complexity. Whereas, other programs that you're interacting with in a more deep level, especially talking back about cybersecurity companies have gone hit on this a little bit. No one's going to go replace their cybersecurity with an AI in anytime soon because there's simply too much risk to that. There's too much going on. Maybe the AI companies or the cybersecurity companies are using AI to help identify threats, but you're not going to go replace that stack of software, not anytime soon that I see with an AI.
Right. And I think as far as on the professional services side, I mean, you mentioned tax. I think for sophisticated and complicated situations,
absolutely,
whether it's tax, legal, investments like we're dealing with, it's going to be a situation where you're really utilizing these AI tools to help provide better results for the client. But I think being able to translate the needs from your client into the software that will help you drive a better result and a better offering, it's going to require that intermediary to understand more on the client situation, because I think it's going to take some time before, whether it's an individual client, whether it's an enterprise or a business, I think it's going to be some time before people just open up completely all of their data, all of their information, and just, say, hey, AI, take the wheel and tell me what I'm supposed to do. You now have access to everything that I know that I own, that that is sensitive within my life, my business, whatever it may be. So I think there's going to need to be that interpersonal buffer, if you will, and AI is just going to be a way to drive better results for individuals, for businesses. Now, that's not saying that it may not displace people or displace jobs, because there may be found that there's some jobs that are just no longer needed. But I think we're a long way from AI just replacing everything. And so it's really interesting to kind of reanalyze companies and businesses, business models, and determine, hey, where is AI filling the gaps? What are they replacing and what are they not?
I absolutely agree. And it's, go back on the tax example, we've seen AI replace, some entry-level jobs, and I think on the very basic case, it can replace some tax software. But again, having that intermediary, you're talking about financial information, healthcare information, in chatbots that are currently talking about being ad-driven and monetized through advertisements, and talk about personal targeting of advertisements in social media. Well, now you have a program that knows your financial situation, your health situation. So I agree with you. I think it's going to be a while before people feel comfortable uploading that kind of information into AIs. And also, having that intermediary, not just as a buffer to that, but also clients of ours, of accountants, of doctors, they don't always know which questions to ask, what to, answer, how to prevent things in the future. Maybe it's structuring your company somewhat differently going forward because, that has whatever tax benefits. All of these considerations that AI isn't currently at least equipped to just provide. And have you considered this? What's your feeling about that? And so I think there's still a lot of value to be had in having those intermediaries, especially on the more complex side of these things.
Yep, absolutely. Now, as we kind of wrap up risks, I just want to mention briefly, we've talked about whether AI is a bubble or not already on prior podcasts and literature that we've put out to our clients and our followers. But I think just drilling down to the heart of it, at least for what I'm watching, is I think this could be, and I mentioned this kind of at the top of the episode, this could be a year where you see your mega cap names just have to go through a digestion period as investors say, hey, you are spending a ton of money right now. I think it's going to pay dividends in the future. So I'm not willing to necessarily sell your stock, but I'm not chasing it either because I want to see more results. Now, you have seen pretty solid revenue growth out of names like Meta, out of names like Google, even Microsoft, generating revenue from some of their AI initiatives, but the massive spend really warrants kind of a pause on some of those. And so all this being said is that if we have those mega cap, your huge contention of the Mag 7 taking kind of a pause this year, maybe single digit growth or something like that, well, you got to look to other areas of the market because I think there is going to be a lot of wealth generated for companies this year because of all the macro factors that we've outlined in these last two podcasts. And so, expanding the breadth of your portfolio could be really valuable, not just index fund investing, finding the areas and pockets of the market that are going to benefit, because everybody who's tied up in ETFs that are just tracking the biggest companies, you may have just a mediocre year this year. And of course, we can't, there's no kind of guarantee, everyone has to do their own due diligence, but I could see it certainly being a year for something like that.
Yeah, I agree. And, part of that is, like what we mentioned in the healthcare space is an ETF is giving you all of it. We're here to be tactical investors and dive deeper than that and find the places that make sense to us. And so, that's really what it is our opinions on what we think is going forward, not necessarily advice for everybody, but certainly our thoughts on what's happening. I think that's a really interesting time that is coming back, like we've said it before in prior podcasts, of into a more stock picker environment. Not everything's just going up and to the right with a beta of 1 or mega caps at least, but it's parts of the economy, and especially like you mentioned, I agree that probably a lot of the smaller companies too, they're doing really exciting things that may not have been acknowledged in the same way that the Mag 7 have over the past few years.
Exactly. And I think the other benefit of being active is that you're flexible. I don't think we've ever seen a news cycle that is so fast, so complicated, and driving such drastic moves in the market than we are seeing today, especially with AI just providing new headlines about disrupted industries and sectors on what feels like a daily, weekly basis at this point. It's important to remain tactical in the way that you're positioned in your portfolios, having a balance of that equity positioning, but also conservative investments, which we'll have to talk about more on a soon to be released podcast, because I think that's such an important part of your basket outside of your equities that we're focusing on in this conversation. But maintaining a diversified portfolio, being tactical, being flexible, I think is going to yield a lot of benefit this year.
Yeah, absolutely. I think here and in broader coverage, the equities get a lot more attention. They're very exciting and good reason that they get a lot of attention. But I am excited to dive more deeply onto the safer investments and some actually really exciting things that are going on in that space nowadays.
Absolutely. Thank you for joining us. If you watched all 3 of these segments and you haven't tuned into our newsletter itself, feel free to give it a read. It's on our website at beckcapitalmanagement.com. We covered a lot, Hunter, over these last 3 episodes. AI, infrastructure, the Fed, macro factors driving the market in 2026, sectors, and finally the risks facing the market. I think we covered a lot. If you have any questions, reach out to us directly or drop us a comment on whatever you're watching or listening to this on, and we will be happy to get back to you and listen. Of course, everyone has their own objectives, their own investment, situation, their own financial goals. and risks. So invest accordingly. Don't just take our advice at face value. But if you want a consultation, that is what we're here for. That's what we love to do with clients.
Yeah, absolutely. Appreciate you adding that plug in, because it's been a lot of material, and appreciate y'all sticking with us.
Yep. And we have more insights on our website, as I mentioned. Follow us there and stay tuned for more Beckonomics episodes.
Great. Thanks, Victor.